I'm your host, John Sleeting, and today I'm joined by Chris Geyer.
I was getting to the point where I kind of missed where I had started, and this group had gone out and formed Hennepin Partners, a bunch of folks I knew from my days at Lazard. Early in 2023, the opportunity came up to join the firm, and I jumped at it, and it's been a great ride ever since, and that's when we got to know you.
The expertise, I get it from the buyer end. Why is it so important in terms of the banker representation?
But having an understanding of what are the key dynamics at play in a business like Exacto that has to deal with supply chain issues, with commodity pricing, with certain customers, right, in the agricultural value chain that can be tricky to work with. And so those are some of the things that a banker can bring to the table and just make the process more smoothly and frankly allow us to get up to speed on the business faster too as we're getting engaged.
Hello, and welcome to Clear Conversations, the Entrepreneurial Legacies series. I'm your host, John Sleeting, and today I'm joined by Chris Geyer. Chris is a managing director with Hennepin Partners. But before I go more into the episode today, I want to pause on a few items. I want to thank Chris and our prior four guests for this M&A mini-series. I hope you found it instructive, insightful, different perspectives from human capital to exit planning to the transactions themselves, the example of the roll-up that we talked about within the marketing and advertising space. Each of these five were put together very specifically with the different dimensions, and you're going to get that again from Chris today. So I encourage, as I have throughout this mini-series, think about who you might forward this episode onto, because I think there's going to be a lot of depth that you're going to gain from Chris. And when I say forward it on, there's a few statistics that I was recently made aware of from the reach in what's happening with this podcast series. For listeners, I don't consider myself a podcaster versus the managing partner of Family Office Services. Seems like two very different worlds. But the people that I am able to come in contact with, I'm humbled by, I'm honored by, and wanting to honor their conversations. And when we were going through statistics recently, top cities, so not surprising in terms of Chicago, our hometown, the second largest city is London. The next is New York, and then the fourth is Dallas. So the listenership is global as we think about it. When we look at countries, the United States, well, that makes a lot of sense. Followed by the United Kingdom. Well, that makes a lot of sense with London in there. But Canada, Australia, Germany, Sweden, Poland, the listenership continues to expand. That is also extremely humbling to me, that the topics that we're sharing are resonating, that people are taking in this content, and I hope learning from it. And if questions do arise, please reach out. And now on with Chris. Chris and I first came in contact with one another and introduced to one another with a transaction that was processed over the last couple of years and closed last fall, the fall of 2025. Chris, being a managing director as an investment banker, has got a great career, decades in the space with a few different firms that brought him to Hennepin. And then his role in this specific transaction was valuable to end in a successful and great outcome for the family that they were representing. But the detail, the process, because most families will go through a process like this once in a lifetime, maybe twice if they're lucky. And so it is very foreign. So in today's episode, our objective is to really demystify this process. What is investment banking about? What is an exit or a monetization process really? What are the steps in it? What's the intentionality? How do you get prepared for it? And then how do you prepare yourself for what you're about to go through? So Chris's understanding of the process in great detail, but trying to share it in as tight a format as we could here for you to get a glimpse into what you might be considering or those around you. And that's why I want you to think about who you may forward it to. So with that, Chris, thank you so much for carving out the time, flying in to be here as part of this conversation today. I look forward to exploring this mergers and acquisitions space from an investment banker's point of view.
Well, John, thank you so much for having me. I appreciate the opportunity, and I look forward to the conversation.
So as we start getting definitions correct for listeners, let's start with an investment banker's perspective. What is an investment banker for those that might not know or even have questions, right? A lot of people think that they know about the space, but they make up the definition in their mind. How would you define what an investment banker is?
Yeah, and investment banker can mean different things to different people, but for the context for mergers and acquisitions, for M&A, as we talk about it, really think about it as an advisor who's going to help a client get from point A, which is starting a sale process, to point Z, which is all the things that have to happen in between to successfully conclude a process. I always, to kind of dumb it down for people who don't really know what I do, I tell them I'm kind of like a real estate agent, except I'm not selling a house, I'm selling a company.
Okay. And so when people hear banker, though, too, a lot of people think the commercial banker. I could just talk to, I already have a banker, right? I can talk to my commercial banker.
Right.
That's not what we're talking about, right? So if you're borrowing, right, if you've got your line of credit, your lending facilities, and whether it be from a direct commercial bank, right, whether it be from private credit sources, right, there's a lot of sources of lending that takes place. That's not what we're talking about, correct?
Right. No, we're not. There are investment banks out there that have balance sheets that will lend to people, but when you're talking about typical merger and acquisition advisors, yeah, the term bank is a little bit of a misnomer, right?
Okay.
Think of us more as an advisor,
okay,
as a consultant through your M&A process, not somebody you're going to go to for financing or for credit or things like that.
And so you're a partner with Hennepin Partners. Sharing a bit more, who's Hennepin Partners then?
Yeah, I'm a managing director with Hennepin Partners, so I just want to make sure I'm not claiming to be a partner, because I'm not a member.
I'm giving you more credit than
appreciate that. I'm not a member of the original founding partnership, but so we're a Minneapolis-based, sell-side focused investment banking boutique, and people use the term boutique oftentimes to refer to just a smaller bank, so a more kind of specialized bank. We're about 40 individuals. Probably average transaction size we work on is somewhere in the $50 to $75 million range, but we work on deals smaller than that, and certainly we work on deals larger than that. So 20 to 200 million is kind of the size range that we typically get involved in. We're again mostly sell side focused. It was a firm that was formed by a group of individuals who were bankers at a much larger global multinational bank called Lazard. They spun out of that and decided to form their own partnership in 2018.
Okay.
The idea to take the experience they'd gained and all the things they'd done at these big multinational banks, doing $100 million plus transactions, and bring that to the lower middle market. And we can talk about how we define middle market, lower middle market, and all those kind of things. But the idea is to bring that level of service, that level of tenacity, that level of experience to founders, owners, entrepreneurs, people selling smaller businesses.
Okay. And so the focus then, so you said it's a lot of sell side, right? Some buy side. Do you all get involved then if somebody wants to take a company public? I mean, in terms of lunch and IPOs, I mean, what are the other activities maybe that investment banks very broadly would get involved with that's not necessarily the focus of Hennepin Partners?
Yeah, if you look at investment banks, generally big banks we've all heard of, Morgan Stanley, J.P. Morgan, Bank of America, they support both M&A transactions and public market transactions, or even private capital raises. So they'll be involved in IPOs, they'll be involved in secondary capital raises with the public markets. At Hennepin Partners, we don't do that. So we're not public market facing. We're really working on M&A advisory. We'll occasionally do some private capital raises, or maybe minority capital raises for a client. Typically, it's in the context of maybe a dual track process where a client is thinking about selling, but they're also thinking about, maybe if I raise some capital, I can just take in a minority partner and continue to kind of grow and expand the business on my own.
Okay.
So we'll occasionally do that, but for the most part, 95% of the time, we're representing you selling your business.
Okay. Well, and that's how we first became introduced, and we'll talk a little bit about more about that.
Yep.
But that's why there's this overlay too of Clearwater Capital and who we are, and then the role that Hennepin Partners plays. You mentioned a little bit of the definitions around lower middle market, middle market. Yep. But so how does the market get segmented when you think about enterprise value for businesses?
Yeah, and everybody has different definitions, right? But typically, I would think of what people call the middle market now as probably transactions that are between $200 million and $1 billion, or maybe even more than $1 billion. And then there's the really large deals, which people refer to as the bulge bracket. And so those are the deals you're reading about in the Wall Street Journal, public company transactions, things like that. When you start to get under $200 million, we often refer to that as the lower middle market. And because these aren't small enterprises by any means. I mean, a lot of these are very old, established businesses. They're just not doing hundreds of millions of dollars in EBITDA.
Yeah.
They're a lot of times, between $5 and $20 million of EBITDA. Transactions between maybe $20 million and $200 million is what we kind of define as the lower middle market.
Okay. And so you've been on the street in different capacities, different organizations.
Yeah.
So for our listeners to get familiar now with Chris a little bit more, did you grow up dreaming of being an investment banker? Did you grow up, thinking about, I wanted to be at Hennepin? I mean, how did your career then evolve over time? Yeah,
it's interesting. I probably wouldn't have ended up an investment banker today if I were 21 years old now, because it's changed a lot. But so I'm a Minnesota native, born and raised in the Twin Cities. I went to the University of Colorado in Boulder, Colorado for undergraduate. Between my junior and senior year of college, I had an internship at Piper Jaffray, what's now Piper Sandler, but back then was known as Piper Jaffray, which is a large Minneapolis headquartered investment bank. To be honest, I was looking for a job in finance, and I knew a couple people that worked there. They somehow helped me get an interview, and next thing I knew, I had an internship, and I was working in an investment bank. And I still remember my first day as an intern. I didn't really know what I was getting into. The next thing I knew, I was still there at midnight, and I was living with my parents that summer, and they were probably about to put out a police report to figure out what happened to me. But so I had that first summer experience at Piper, and then after I graduated, I came back and accepted a full-time job and did a 3-year analyst stint, which is what a lot of young folks who get into the profession will have, kind of a 2 to 3 year stint out of undergrad. So I did that.
So, and maybe even to share a little bit more there, if there's young people listening, right, and they're thinking about just a job in finance, if they wanted to go down this path, or they wanted to get in, there's, as some people would say, the attractiveness of what the space is, right, the rush of the transaction, the adrenaline, the work intensity, right? People that are going to be attracted to that. What does that really look like? If on day one in an internship you're there till midnight, right?
Yeah.
What does that really look like for individuals that might be pursuing it as a career path?
Yeah, it's a field where you do get that. You get to kind of scratch that competitive itch that a lot of former Division I athletes are investment bankers, or certainly not all, but that's the kind of thing that you see a lot of times at these firms. People that are very competitive, people that are hardworking, very driven. I often tell people, if you want to get a job in an investment bank out of undergrad, be prepared to get 4 years of experience in 2 years, because you're going to work probably about that much. But it's incredibly rewarding, and it opens up a lot of doors for you, whether you want to continue in investment banking, whether you want to move to private equity or move into the corporate finance world. It opens up a ton of opportunities. You'll come out of it 2 or 3 years after you start, really with a ton of experience. Part of the reason I joke that I don't know if I'd get the job now is because now we're seeing the recruiting process for investment banking starting when people are sophomores in college, and trying to get those internships between your junior and senior year is getting increasingly difficult, increasingly competitive, even at a smaller firm like ours. And so anyone who wants to get into it, hopefully they figured out early on that they want to get into it, because it's hard to come into it later. Now there's different ways to do it, but it is very competitive.
And so what would you encourage someone then in their sophomore year at college, if they're thinking about this as a career path? Do they go to the bulge bracket firms, right? Do they think about going to more of a boutique type firm?
Yep.
How would you counsel that? Because you've got a couple children right in that age bracket, right, that age zone right now. And if they said, "Hey, I want to get into this," what parental advice, coaching would you be given to them?
Yeah, I think networking is very important. Learn, find people in your network that maybe are doing it, or have people that you could get connected to. Talk to them about their experiences. Do that early on. And depending on where you go to school, a lot of universities have investment banking programs. So getting involved in those as a sophomore or junior in college can be very helpful, and that can help open doors for you. In terms of going to a larger bank or smaller bank, I tend to tell people my advice would be start big, and it's easier to go small than vice versa.
Right.
But that doesn't mean that a large bank's going to be the right fit for everyone either, because the cultures can be very different, and you may talk to, Merrill Lynch or Morgan Stanley, and you may talk to Hennepin partners, and you decide, I fit more with these Hennepin partner folks. So.
Right. Well, from my corporate time, my G Capital years, and going through, I kind of say the same thing to a lot of young people. Right. You can go big, and you can get a lot of training, a lot of resources, and go small into the future. But if you start small, right, it's really hard to swim upstream to go the other way if you think that that's the path. So if you can start big, it doesn't mean you have to stay there forever, right? But take advantage of the resources too and the training, and not just being a number, right, or a cog in the wheel. But in certain ways, you can get a lot more out of that time period, and just the exposure in order to make a better decision regarding what is the right fit for a smaller firm into the future.
Yeah, absolutely.
And so over time, so you starting out with Piper back then, and then leading through your career now too with Hennepin. I mean, you've been in the industry now yourself, going on a couple decades?
Yeah, I've kind of had two stints. So the first 3 years, then I after that I went and worked in corporate development and corporate finance for 3 or 4 years for what was at the time a small cap public company called Integris, which has since gone through several mergers and is now a multi-billion-dollar company. But when I worked there, we were pretty small. So
help people understand. So corporate development. Again, I get that from my corporate days in terms of the teams that are on board that are doing this work too. So what is corporate development in a larger company? What is the role then that you played there?
Yeah, so there can be a couple roles, and in the role I was in, there was both the internal strategic planning, and I, as a younger person at the time, I was in charge of building kind of the forecast models and doing some of the longer term planning. But it was also the internal arm that looked outwards for M&A opportunities. So as a corporate buyer, what are businesses we look at and say this would be a great fit for us? And then you're kind of the team internally that is working to execute those more from the buy side than the sell side.
Yeah. And there's still, go back to my GE days, they're always buying or selling something.
Yeah.
And so there was hey, this doesn't fit anymore, or this part of the portfolio, let's go ahead and sell off
Divest
those
that.
assets or that business, whatever it might be. So that becomes insourced in large companies. But smaller companies, right? Or if we're talking that lower middle market of a few $100 million of enterprise value, they're not going to have the staff to do that. So how should they? Because they still need to have the same thought process, right? It's still strategic planning. It's still looking at what's organic and what's buy, build, or borrow in terms of the way that they're thinking about it. So when you take that corporate development, bigger investment bank, maybe transactions that you were working on, and you think about that now with smaller companies, how should they be thinking about it? And how can they leverage, or do they, individuals like yourself or, groups like Hennepin?
Yeah, some companies will, even smaller companies may have folks internally that drive the M&A process from a buyer standpoint. Maybe it's somebody in the CFO's office, right? If not the CFO themselves. But we do find that for those types of organizations that just don't have the internal resources, they can hire a buy-side advisor. So hiring someone like Hennepin or a firm like us to represent them on the buy side. It allows them to outsource just some of the day-to-day work that needs to be done, all the due diligence, all the financial modeling work. They can bring in resources to do that. The other thing is it signals to the seller that we're serious about this. We're actually spending money and hiring an advisor, and we're putting resources towards this, so you should take us seriously.
Right.
Because the challenge smaller potential buyers face is that they're just a small company. Do they have the resources? Do they have the money to do it? But if you're showing that you're willing to put that effort forth, then it allows you to be taken more seriously.
So what was the change? What drew you to Hennepin? How long have you been there?
Yeah.
What was your decision criteria when you were looking at it, all the different options and the firms that you were really attracted to? Why did you select Hennepin from a career viewpoint?
Yeah, so after my time in corporate development, I went back and got my MBA from the University of Minnesota from the Carlson School of Business. And then not really with the intention of necessarily getting back into investment banking, but I had a network and I knew people. And next thing you knew, I was getting my MBA and I was starting at a firm called Lazard Middle Market, which is, as the name would imply, the middle market kind of arm of a much larger global multinational bank called Lazard. I spent 9 years there, and then I moved back to Piper Jaffray, which became Piper Sandler, and I spent another 6 years there. So I had 15 years in large, kind of global multinational banks. And frankly, I was getting to the point where I kind of missed where I'd started, and working with owner entrepreneurs, working on smaller businesses, smaller deals. And in the background, while I had been working at Lazard and then at Piper, this group had gone out and formed Hennepin Partners, a bunch of folks I knew from my days at Lazard. And so maintaining those relationships and knowing they were, people of high integrity and really good at what they did. Early in 2023, the opportunity came up to join the firm, and I jumped at it, and it's been a great ride ever since, and that's when we got to know you. So
there's probably a lot of life lessons and business lessons out of what you just said, right? I mean, people of integrity. Yep. It's a small world, right? Yep. Relationships and continuing to stay in dialogue. Your reputation, their reputation, in terms of coming back together again. And that's where even as people move, right, and they move between different organizations, between Piper and Lazard, and it's way too small of a world for everybody that's out there in terms of what you're doing, how you do your work, but then also the relationship component, because all the transactions, we can talk all the technical aspects, but still relationship driven, right? It's still the people you end up working with, whether in the office or the engagement with, the families or the boards or the executive teams that are selling the company or buying another company too.
Yeah, it's a very relationship-driven career path, right? And so most people that have a career in investment banking probably don't spend their entire career working for one bank. At some point, for whatever reason, they move from one to another, whether it's a better opportunity or things like that. So you don't want to burn those bridges, and you want to maintain relationships because you never know what door it's going to open for, in my case, 10 years down the road. So
right. Well, and I do want to come back to, you talked about how we connected. What are all the different verticals, right? Business segments. I mean, if you were to draw the strike zone for Hennepin Partners, what does that strike zone look like that says, this is the kind of transaction we do all day long? Yeah,
so there's a couple of different kind of ways you can think about it. One is we're probably a little bit skewed more towards founder-owned businesses. Maybe 60% of our deals tend to fall into that category. The balance, and most of the balance, would be private equity. So we work for private equity firms who are buying and selling companies all the time. And then we do some corporate divestiture, corporate carve-out work here and there, but that's a pretty small piece of the pie for us. That tends to be something that larger banks do just because they're working with Fortune 500 companies that are selling somebody. So you can look at it that way, and then if you look at it from a kind of an end market breakdown, we've got a pretty even mix between what I'll call generally industrials transactions, and that's kind of the area where I fall into.
Okay.
Although in the case of our deal, it bled into agriculture as well, which is another vertical that we service. We have a team focused on consumer. We have a team focused on technology and software. And then business services would be probably the last piece of it that would kind of round out the pie chart for where we spend our time.
Okay. And then, and to remind listeners, right, a little bit of that overlap of how we came together. And then I want to walk through a little bit of this demystifying the transaction and how that works from day one. But where we came together, and I think listeners have heard the conversation just recently that we posted with Kip Pendleton, where Kip and I served on the board together for Cox Mimi Holdings. And the Cox Mimi said we could have that recording that we've now posted, and they blessed it after listening to it, and so we're all good there. We'll give them the opportunity to listen to this one too, and going through it together, as well as then Kenny Cox episode, which is one of the first ones that I had completed. Clearwater Capital is a multifamily office component. We have two other areas that are private wealth management and then also institutional, which is really qualified, non-qualified type planning for a lot of those business owners that we serve. But in the multifamily office services, really our strike zone and the overlap here is families with 30 to 300 million of net worth in terms of their balance sheets, from estate strategy thought process to their tax planning and the investment management. But when we look at that asset allocation, and a lot of people think about that, okay, as stocks, bonds, cash. When you look at the Global Family Office Report, the best allocation work that has come out really even looks at multi-$100 million families, billion-dollar families with like a 55-45 split. 55 towards public markets, so traditional stock, bonds, cash, anything you can access public. 45% on the private side, private real estate, private direct, private equity, fund management that comes into play. And so when we look at it, well, we're planning for the totality of one's balance sheet. And as a family looking at it, going, yeah, I've got this asset that's on my personal balance sheet. How do I think about the estate planning, the charitable planning, the structure, succession in the family or not?
Right.
And all those conversations that take place do end up surfacing into, okay, well, what if I go down this path in terms of sale?
Yep.
Kenny had asked me years ago, we've been working together now over a decade, to chair the holding company board for him, because as an owner, he wanted to sit back. Family was over 4 decades old in the family, and he wanted to sit back, be a board member, be an owner, be a board member, take in the information, not worried about managing the board, but also in terms of CEO thinking about, okay, what's in my overall portfolio and how we approach that. And so everyone should, if you want to get a little bit of a flavor of Kenny, listen to his episode.
Yeah.
Kip shared a great perspective from the boardroom.
He did.
Overall, right? So you've already had a chance to listen to it coming into today.
It was great to hear his perspective on some of the stuff that happened behind the scenes that I learned about after the fact. So.
And so the preparation, the strategy that he hit on, and Kip doing 49 transactions, and he's done, I think, multiple with Hennepin in the past. And yet his objectivity of coming in and saying, no, we've got to get the right banker and the right attorney to start, and how we're thinking about this. Yep. So we as a board had said, Kip, you run point overall in terms of the transaction as we're coming alongside Kenny. What does this mean for the family? And then working with the executive team too. And Kip played a phenomenal role in that and how it played out. So that's a little bit of like how our overlay working with the family, my involvement with them, Kip's involvement from that episode, and then we get to the point of saying, yep, let's go out and talk to both transaction attorneys, because it's different. It's not your estate planning attorney. It's not typically your general counsel, depending on the size of the company. Different attorneys have different expertise, and we had a fantastic one in Ryan at Fagery Drinker in terms of representation. And then Hennepin Partners was the firm selected then to lead and represent Coxswain Holdings in this transaction that took place. But now on the receiving end, the demystifying of this entire process, Kip sends an email in, right?
Yeah.
Comes to your desk and says, "Hey, we're considering strategic alternatives," right? The old strategic alternatives.
Code for maybe selling the company.
Right. So how does that get received on your end, and what does that kick off then on your side of the fence, so people understand, okay, here's what a process really is about, right?
Yep.
To really to walk people through that.
Yeah, so in this case, and you mentioned that Kip had done some work with Hennepin Partners in the past. So one of my colleagues at Hennepin Partners, a guy named Matthew Fitzmaurice, who's another senior banker.
Great
there.
respect for Matthew.
Yeah. We spent a lot of time on this transaction together. So Matthew leads our ag tech practice, and so he had a relationship with Kip, given they both spend all their time kind of in and around the ag sector. He received a inbound call from Kip saying, hey, we're looking for a potential advisor for Exacto. Matthew brought me in alongside of him because I come from a specialty chemicals and materials background, which Exacto is basically manufacturing specialty chemicals and different additives used in the agricultural value chain. And so as Hennepin Partners, we said we want to come kind of at this from two dimensions. One is the chemicals and the materials, and the other is the ag expertise. And I think that's one of the things we can talk about, but finding an advisor who has expertise in the areas where your business traffics is important. And so that's one of the things that we try and do our best to represent to our clients, that we understand their business, we understand the markets they're in.
So
But
if we can pause even there, Chris, as we keep going through the process to take that, even that very first step, when we're looking at, because we talked to several different investment banking groups, but that aspect of like if someone's listening right now and they're thinking about going down this path and making that same phone call that Kip ended up making inbound to Matthew, in that selection, that thought process, why is it so important? I mean, it's like intuitively you get it, but I don't want it to be intuitive and I don't want to be assumed in.
Yeah.
It's like, why is it so important in terms of that fit with respect to where you're trafficking, the expertise? The expertise, I get it from the buyer end. Why is it so important in terms of the banker representation?
Yeah, and there's a lot of components to the expertise that I think a banker needs that are important. One, and I don't want to overstate that they have to know every strategic player in the market or things like that, but having an understanding of what are the key dynamics at play in a business like Exacto that has to deal with supply chain issues, with commodity pricing, with certain customers, right, in the agricultural value chain that can be tricky to work with. Mm-hmm. And so those are some of the things that a banker can bring to the table and just make the process more smoothly and frankly allow us to get up to speed on the business faster too, right, as we're getting engaged. So and maybe just to go back to so we get the call that somebody's interested in talking to us. So what happens on our side? Well, we know that it's a competitive situation, right? We're not just being called and handed an assignment, but we have to come and earn it. And so we put together a presentation, usually in banker parlance, it's known as a pitch, and it's maybe a 50-page presentation of why are we the right group to help represent you, Mr. or Mrs. Seller. Who do we think the right buyers are for your business? What does the buyer universe look like? What do we think how should the process be designed given the facts and circumstances of the situation? Probably most importantly, or what every seller wants to know, is where do we think the business is going to trade? What type of valuation range do we, would we guide you towards thinking of as a good outcome for the business? Right. And one of the important nuances is, unlike the real estate agent who lists a house at a certain price, bankers don't go out to the market and say, company XYZ is for sale for $100 million. We go out to the market and let the market tell us, right? But we need to have that dialogue with our market. Yeah, and we need to have that dialogue with our client early on to make sure expectations are aligned. Because if you think your company's worth twice as much as we think the market will bear, then that's not a great,
And everybody does, right?
Everybody
does,
right? So we spend some time getting all this material together, and then
when you say some time, like what is that? What is that sometime?
Typically, it's we'll get the call. We try to be in a position within a week or two where we can come and present very thoughtful analysis to you. So. Depending on how much time we're given by the potential client, that can be a kind of a mad scramble to get everything together. If you talk to investment banking analysts, the pitch that comes up on a Friday night is always exciting for their weekend. But we want to be thoughtful in what we pull together, and these are bespoke presentations. This isn't just hey, we'll pull this off the shelf and go tell these people about what we do. It's
when the amount of information that gets packed in that kind of a compressed time, and this is true with the various presentations that we saw, but Hennepin got selected for a reason, but the effort that the team put in, it was twofold. Well, one, it has to be in good faith from the individuals coming in saying, hey, we're thinking about this. Doesn't mean you had to decide and sign a piece of paper that you just sold your company that day.
Right.
But in good faith coming into this. Why? Because there's a lot of people working through the nights to get pulled together because all of a sudden the timeline is very short.
Yep.
And it's this strange juxtaposition because the processes take a long time. It takes a long time. But the speed and the internal cycles that are running within that it can be exhausting for people, right?
Yep.
It can be really tiresome for your team, for everybody involved.
For the client as well.
For the client, and it's like, why is this taking so long? And yet people are, burning that midnight oil, so to speak,
right,
in order to get it done. And so the decks that were presented, within that roughly that week. And the insights that were shared back and the perspectives that were shared back, huge value, even if things stopped at that meeting, right? Which is not the intent in bad faith to turn the cycles on everybody. And only one firm is going to be selected, right? So a lot of people burned a lot of time, and that's part of the process and going through it. Yeah. And that's why it's competitive, right? It's like, no, you got to bring your best foot forward, because after that one meeting, I want to say it ran about 45 minutes or so, plus or minus around there.
Right.
In going through and walking through that with you and with Matthew and the extended team that was all part of bringing that together. But it was also not this, hey, come in and present for a half a day and all the different pieces that are out there. But it was 50 pages roughly, right, in terms of where it's at. And yet it becomes intense pretty quickly with things.
Yeah, and one of the things that we develop as the ones delivering the pitch is to read the other side of the table and say, are they interested in what we're talking about right now, or do we need to move on to the next thing? And because you don't want, you're right. Usually we're given maybe a 45-minute, maybe an hour and a half window to have a conversation with someone where they're going to make a decision that could be one of the biggest decisions they ever make, or lead to one of the biggest decisions they ever make, which would be to sell the business, right? So, so not only having an advisor that you feel brings the right expertise, but having an advisor that has experience in just has run hundreds of processes, and you have to have a personal connection. I mean, you're going to know that you're going to be working very intimately, very closely with each other for an extended period of time, and you need to understand that this person and I, or this team and my team, can do this together. And I'm curious, from your side, but you either kind of come away from those meetings with that feeling to some degree, or maybe you don't, and that helps the decision process from the company side. Yeah,
you end up with the aspect. I mean, all the teams are great teams, so the competency really high level. I think there is that aspect of that alignment, right? I've got other families, and they've got some investment banking groups that are so narrowly focused in not even just an industry, right, but in a subset of a subset of an industry, and that's all but they are the go-to when it comes to knowing everybody in the ecosystem, knowing everybody, and those are the only transactions that they're doing. So bringing in that expertise and then having the breadth of the different perspectives, like you said, from ag, from specialty chemical, from manufacturing, because it's multifaceted in this particular instance in terms of having the different expertise, and then the network that's out there. And then the chemistry, and different personalities in different ways.
Right.
And I think the trust, and Kip's done 49 transactions. All of them haven't been, necessarily with Hennepin.
Right.
So no secret there. But coming back and getting the right fit includes that chemistry. And I do think the chemistry piece is really important. And I go back to why, because you're going to be doing this for a long time. The process takes a long time. And the pace of the cycles and the interaction and how you operate, the learning curve on that together is pretty steep.
Yeah.
And you can step on each other's toes at points and times, and bonk heads with one another in terms of where it's at, but all in a professional way with respect, in a way that you're all aligned to what's the right thing ultimately for the family doing the selling in this case.
Yeah.
And I think all those things contribute into going, this is the path, because when you say go, pretty quickly thereafter, it's like, okay, now we kick off another whole series of steps in the process.
Right.
But that first one it's speed dating, and yet it's a once in a lifetime type decision that kicks in too.
Absolutely.
To get married really quickly after that speed dating in terms of things, right?
Yeah.
And you understand each other's ugliness or warts or whatever, however you want to describe it, pretty quickly.
Right, because it's the path through a transaction isn't going to be all sunshine and roses, right? And so, can you work with your client to deliver tough news when you need to? Can you keep them hopefully somewhat emotionally level when things are up and down? We joke about a banker almost has to have a minor in psychology, right? Especially if you're dealing with founder entrepreneurs, because the types of people that are successful in building businesses tend to have strong opinions about things, right? But they're not. That doesn't mean they're always 100% right either. So how do you work through those situations?
Right. So then after you get the follow-up call saying, okay, you've been selected, What is that kickoff in the process?
Yeah, so then typically we do what we call a kickoff meeting, and in the case of Exacto, we came down and met with the board and members of the management team directly. We'll take the whole team through, all right, here's what to expect. Here's what the process is going to look like. Here are all the steps that we need to work on to kind of achieve the right outcome. One of the first things we start on is the preparation work, and there's a ton of preparation that needs to be done. And I think that's one thing people need to understand is you don't just hire a banker and then you're in the market 2 weeks later, right? I think in the case of Exacto, it took us several months because we wanted to make sure, A, that we were in the right time of the year where we could get credit for how the company was performing within that fiscal year, but also that we had the strategic plan, we were able to tell the story right, that we had the financial model built. So there's all kinds of things that we need to start working on and need to get input with from the team, and we want to start doing that as quickly as possible.
And if we pause there in terms of the strategy piece of it, so encourage listeners, go back and listen to the KIP episode, right? This is a little bit of the sequels, I guess, that we have, because KIP talked about all the strategy work that actually even led to the fact that this would have to be pursued, or the desired path was being pursued regarding a significant capital partner in terms of achieving some of the growth objectives. So there's a lot of strategy work that was done that led to the phone call from Kip to Matthew. But now you're saying that there's more strategy work to be done. What was the focus of that strategy work and the understanding and the dialogue with the executive team in terms of revisiting, right? It wasn't undoing or redoing what was done in the past. So what was that strategy work like?
In this situation, I think us coming in as the banker, or our group coming in, we were fortunate that Exacto actually had done that work in advance. Many times we come in and the strategy is, well, this is what we've been doing and we're going to just kind of keep doing it. And I don't mean to speak, poorly of any clients, but that's the way a lot of smaller businesses are run, right? And so the nice thing in this situation was that the foresight had been done to do this work in advance of the process, which was incredibly useful for us. But then it's how do you take
Would you say that? I mean, would you say in best practice that, do your strategy work to know that you need to call us versus us coming in as strategy consultants to help you figure out what your strategy is?
So the more that there's already a strategy in place, and it may be, as was the case with Exacto, it wasn't that this is the only narrow path we can take, but it was these are the things in front of us, and how do we position ourselves to have opportunities in these multiple different directions, right? And then our job as the banker is to come in and take that and translate it into something a buyer can digest, not only in understanding, okay, why is this the strategy? Why are these the right decisions to be made, 1, 2, 3, 4 years down the road? But what do the financials look like around that? How do I quantify what that means? Right.
There's another episode a couple ago in this mini series on M&A. With Gary Crum, who founded Agora Consulting. And so they don't do the transactions like you're doing, but they work with people on the exit planning inside of the business. And he had a career on the street and looking at it from a buyer's viewpoint, a strategic buyer's viewpoint, in terms of what makes you attractive to ultimately have a process if that's what you want to do for your exit. But you've got to do that work, right? So I do think that aspect of the strategic and the planning and cleaning up and coming back to this point of going, ownership is already there, right? You already have somebody that owns it. Why should they continue to own it? Is it attractive to them as the equity holder? And that has to be clear on the front end, whether you ever go through an event or not. Have that clear understanding of would you buy yourself today because you are.
Right.
Why would somebody else want to buy you? You need to have that clarity.
Right.
And then we talk about it back in our office with the families regarding the preparedness. Do you have it being held in the right place within your estate structure? What else do we need to do with the estate structure or the philanthropic structure that comes into play? Where do you maximize the tax benefits? Because it's usually a big tax bill that comes with the sale of a company. How do you minimize that tax drag or maximize the benefit from different strategies that come into place? And all of that work needs to be done right before you end up entering the process, because otherwise the process takes on a life of its own. You're not going to have the mind share as an owner to be thinking about my estate strategy now on top of this, on top of that, as you start working through the transaction piece of it.
Absolutely.
So you're working with the team now on strategy and getting that clarified and getting it, to be able to communicate and also tightening up some of the messaging too,
Yeah.
right?
And frankly, strategy is one component of it, but there's, you need to put together materials that allow somebody to rather quickly digest what does this business do? What's the reason for this business existing? Why have they been successful in the past, and why will they continue to be, outside of just longer term planning, but understanding the day-to-day operations of the business,
Okay.
understanding who the team is that's driving the business, and is this a team we can back, or would want to continue to back, understanding the financial piece of it. So typically a confidential memorandum has multiple sections to it, and all of those are kind of being written in process at the same time, so that ultimately when we go to market to buyers, and I skip ahead because there's other steps, but you need a very fulsome, comprehensive document where somebody sitting down and reading this for an hour gets a good sense of what this company is and why they should want to own it.
Because it ends up going out to a lot of people that
Right.
aren't going to have the voiceover, so it's got to be
Right.
captured in as tight as possible in terms of how that gets communicated.
Right.
So as you're doing this work, now we're talking about the attorney. The attorney on the side is also starting, and they're in dialogue with you, kicking off their work streams too and prototype documents. So you're not an attorney, you're not representing
Right.
the legal work that's going on, but how does that collaboration amongst professionals then work, and what's the dialogue like back between the M&A attorney and your team?
Yeah, and especially early in the process, for the attorneys, it's understanding. All right, what kind of timeline are we working with here? When is the intent to be in the market? When do we need to have certain documents ready to go? When do you need us reviewing things that are being put in a virtual data room that buyers are ultimately going to have a chance to see? Along the way, they'll probably also be reviewing any documentation that would be going from us to the potential buyers in terms of bid instruction letters. What do we want somebody to come back to us in terms of what their proposal might look like? From a banker standpoint, we know it's important to us. From an attorney standpoint, there's things that are important to them in terms of structuring and things like that. So getting their input in that early on is very important.
And then go over to the accountants, right?
Yeah.
The CPA side of the world.
And that's probably where we spend more of the time up front, is getting all the numbers.
And so help people understand when they kick off the CPA work stream, what is that looking like?
Yeah. And this was a concept that maybe early in my career didn't happen very often, but now in almost every transaction we're involved in, we have what's called a quality of earnings analysis we do, where we bring in a third-party accounting firm, and they do, it's not an audit, but it's got components of that, but they'll basically look at, it might be the last 2 years of a company's financial results, and they'll say, all right, we kind of validate the internal financials, and if this business were to exist on kind of a standalone basis, are there certain adjustments that should be made to the financials to account for what it would look like going forward in somebody else's hands? So we call these add backs. So people often hear the term EBITDA and then adjusted EBITDA. Yeah. And so getting from EBITDA to adjusted EBITDA, what are the different components of that? Maybe, in a simple analysis, maybe an owner, has a private jet, and that expense runs through the business. Well, whoever buys the company is probably not going to have that, and so that would be an add back to EBITDA. But there's all kinds of things that go into that, and a lot of them are much more nuanced accounting considerations. But we want to ultimately get to what's the number that we're going to present to the market, and we want to be in the best position to defend that when somebody 3 or 4 months from now is going to peel apart and go through every number and want to make sure they can validate it.
Already mentioned that your M&A attorney is probably very different than your estate planning attorney, right? You just get somebody else that's focused on that. When individuals are looking at their technical accounting support, can they use the same accounting firm that they've always used? Do they go get a different accounting firm that does the quality of earnings work? And what does the work of that accounting and the financial component, what does it say to potential buyers regarding the CPA firm that did the preparation of that work. How does that dynamic play itself out in the transaction?
Yeah, oftentimes it is a different accounting firm than the firm that does the audit, and in part it's because there are certain firms that have what are called transaction advisory groups. So within the accounting world, transaction advisory are the groups that do these quality of earnings analysis, and they do them both on behalf of sellers preparing to go to market. They also get hired by private equity firms to do it on the buy side when they're looking to buy something. So this is what they spend all their time doing, and they're very good at it. In the case of Exacto, we actually I believe we used the same firm that did the audits, but it's a different team within the firm, right?
Correct.
So this isn't the group that's doing your audit. This is a group that's dedicated to doing these types of analyses.
Yeah.
And it's a critical piece of the equation and of the preparation, and it's something that we need to build into the timeline up front to do it right. You know, if you're selling a business and you come up with $500,000 worth of adjustments to EBITDA, and you think you're going to sell your business for 10 times EBITDA, that's a $5 million difference right there by doing it right.
Right. And communicating it.
Yeah.
And the name from the accounting firm that's supporting that quality of earnings says something to the buyer too, going, can I trust these numbers and move on? Or do they have to rip it apart on their own right to come back and try to redo it again, which then just takes more time, cost, energy.
Yeah.
And they're not looking to add to EBITDA at that point in time. Now they're only looking to have the deductions versus the add backs.
And what those firms will do, those transaction advisory groups, is not only will they do the analysis up front, but then when you get further down the road in due diligence where buyers are doing their work to try and peel that apart, is they'll support our team and the management team, you know, the finance function within the business through that diligence. So they'll be on calls on behalf, arguing on behalf of your client of why these are the right numbers. And so having a group that not only can put the report together, but also that is similar to your banker that you feel comfortable working with, that you know is going to be able to stand up and vouch for the numbers is important.
And in this case, it really did play out extremely well. Having the transaction advisory team and then the technical accountants and the partner leadership at the accounting firm, because of different structures. So if you did the estate planning right and the philanthropic planning and the structuring and what the family needs, and then their tax planning associated with the transaction so that they knew, all right, here's what we're going to have to set aside, here's what the tax bill is going to look like, here's now the follow-on, what I call even mini transactions between other legal entities that take place. Having that all in one place is huge. But if you don't have a CPA firm team that's capable of supporting all of that, you could end up needing to take more time to coordinate on their behalf. So it is one of those things. At times, I'm not saying that anybody should be moving their accountants right now, but if you have a traditional accounting firm that's good at doing your tax returns and how you're thinking through things to date, as you start entering in and planning for a potential transaction, these are all the sort of items that have to come into consideration with respect to your exit planning work before you get on the phone, and then your team is saying, yeah, we need a different set of accountants working on this to get it cleaned up, and now we're bringing in third parties after the fuse has already been lit.
Yeah, the three advisors I think you need in any transaction nowadays is you need your investment banker, you need your attorneys, and you need your accountants to do the quality of earnings analysis. And then there's other things you can do, and this was something that you and Kip talked about in your episode with Kip, was bringing in a market consultant, right, to help take some of the strategic plan work that we've done, somebody who's a market expert in certain dynamics of how that plays into the market, and then they put together some materials that actually were very beneficial in our transaction as well. Now, not every deal needs that. In our case, we felt like it would be additive for what we had to pay up front to do it, and so there are other things like that you can do, but banker, lawyer, accountant, those are the things you need to have lined up.
Yeah, and absolutely agree. And so some people on the surface might hear that and be like, yeah, but John, where does Clearwater fit into this? And describing those three is the focus on getting the transaction done.
Right.
Right. So we talk about what's the role of the estate planning attorney? Well, the estate structuring we should have been doing years before the transaction happened, and then any other follow-on work post the transaction. So that's an ongoing type item, right? Tax returns still have to be done on an ongoing basis. And the role that we play back is effectively that chief financial officer back with the family going through the transaction. Well, we're there before, during, and after in terms of the involvement. So those three parties, those three key parties, and getting that right, that's why I do look at it and say, if you can get the right accounting firm with the heft to do both the taxes and also the transaction work, getting the right investment banker in there, and we're going to come back to that now, saying how do you access the market and actually have true price discovery and what that looks like, and then the right deal attorney too.
Yep.
But you're all sitting in the middle of the transaction, right? That focus piece of now getting that done, and you're coordinating in both directions with the accountants, the attorneys. Back with me, there's estate questions. We'd get different people on the phone when we needed to, to make sure that there was clean documents across the board on everything. But now we get to the point of saying, all right, you've had the strategy work. And now's the time to send out the teaser.
Yep.
So let's start going through. The teaser goes out. Now is the first time that the world is hearing about this.
Now the fun begins.
So let's start with that. What is a teaser? And how do we move forward from there?
Yeah. So while we're, as the bankers, writing the book, we're also putting together a short document. Oftentimes it's one page, it might be 1 or 2 or 3 pages. Summary of what the business does, and this is done on a no names basis. In fact, we have to take good care to make sure that we're not giving away too much of who the company is, because you're doing this in a non-confidential way, right? The potential other parties haven't signed a non-disclosure agreement yet. So the teaser is meant to summarize in a page or 2 what is the business, why should you be interested in it, and so we'll send that out to the buyers that we've agreed to with our client. This is what the buyer list looks like. These are maybe in one instance, maybe it's 15 buyers, and in another instance, maybe it's 500. We spend that time up front kind of designing the process.
And I'm going to pause again.
Yeah.
Right, because this is where when you all first sent the list of who it's going out to, from strategics to financial buyers and others that are in between, the list was hundreds and hundreds of names long. Back to people that know the market, know who potentials are going to be. You're not sending this out to everybody in the world. You're like, no, there's actual thought behind every name that's on here that could be a potential buyer. Back to getting the right people that know that segment or segments that you could be selling into of where the teaser's going. Because for this one, it was hundreds that it went out to.
Yeah. It was our mandate was to go out broadly. We felt like that was what would allow us to deliver the best result to Kenny, so there were hundreds of names on the list. There were strategic buyers, there were private equity owned, kind of quasi strategic buyers, and then there was financial buyers, in the form of private equity firms or family offices. So we really tried to cover all the bases, because in some instances you might have a good sense of, all right, who's the right buyer for this business, but more often than not you get surprised, or who should be the right buyer falls down at some point along the way. So we like to make sure we've got true price discovery by really testing the market. So that teaser document goes to all these people, along with a non-disclosure agreement. If they're interested, they read the teaser and they say, yeah, this sounds like something we'd like to learn more about. They send back a signed NDA, or they negotiate the NDA, but hopefully it's something we get to sign pretty quickly. And then once the confidential information memorandum is ready, the SIM or the SIP, some people call it confidential information presentation, that's distributed to all those buyers that signed the NDA.
Okay. And so in the SIM then is back to that comprehensive 40, 50 page.
Yeah, exactly. It's a 50-plus page presentation. It's got an executive summary up front that kind of captures the essence of the business in maybe 5 or 10 slides. But then it's got much more detail on the operations of the business, on the industry in which the business participates. Why is this an attractive industry? Why is this where you want to be? It's got more detail on the growth plan. How is this business going to go from where we are today to where we're going to be in 5 years, and what are all those kind of steps that we've identified along the way? And then what do the financials look like, and what's the financial summary of the business? And so those are kind of the core components of it. They can have different flavors, but those are the things that we want to make sure are communicated to buyers for that initial kind of dive they're going to take into learning about the business.
Yeah, and so I mean, gosh, we're 9 months post close in the transaction, and we still talk about and we reference. All right, well, this is what was said in the SIM, and here's what was agreed to in the legal documents, and how it was binding, but what was presented. I mean, back in good faith, again, everything that goes into the SIM is like, here's what we all truly believe this is about.
Yeah.
And the staying power of that document is enormous. And I think individuals taking the time on the front end, working with you all to get that as tight and possible and understood, because that document will be in every meeting from that point forward, and even after the fact, everybody will be going back to it going, yeah, but we talked about this in the strategy, and we talked about this number, and here's where it's at with this customer, and all those sort of things.
It's really
just
the baseline
on,
you're setting
for everything.
Yep.
So then when people get the SIM and they go through it and they say, hey, I really like what I'm seeing here, some people will opt out of the process of saying, now I know more, that's okay. But that's why you got to process. Those that say, hey, want to take the next step, what's the next step then?
So when we distribute the SIM, we'll include with that a letter or instructions about what does the initial bid process look like. So we typically call that the initial indication of interest, or IOIs is the term that you often hear. So that's a higher level kind of. If you think about an M&A process, it's typically a multiple stage auction process is what you're ultimately doing. So this is kind of the first point where you're getting feedback now from the market on what they think the business is worth. And so we'll instruct buyers to submit an indication of interest. Okay. We'll set a certain date. We'll collect all those. That indication of interest will typically look at the value of the business in a range. So as opposed to a pinpoint valuation, they'll say, we think you're worth $50 to $60 million.
Okay.
It'll include detail around why do they want to own the business? Why are we the right partner for you? It'll include how are we going to finance it? It'll include what do we expect from management or from ownership going forward? Do we want you to continue to be involved in the business, Mr. and Mrs. Owner, or are we okay if you just want to kind of sell and move on? So there's probably a half dozen key things that we look for in those initial indications of interest, and then we kind of collect that data. Now we've got our first feedback from the market, and now we make some decisions around, all right, how is the process going to advance from here, and who's going to continue to be part of it? Because in the case of Exacto, we got probably 25 to 30 indications of interest. We can't keep all those parties in the process, and frankly, we don't want to, because some of them come back to us with valuations that just aren't interesting. But a lot of them are, and so then it's how do you make those decisions of who do we move forward with?
Yeah, and so let's say you've got whether it be 30, 40, 50, right? At that stage, nothing magic about an individual number, but what do you want to boil it down to in the funnel at that point in time to take the next step? Because each step along the way takes more time and energy and resources by everybody involved. So part of it, you want to cut it down, but you don't want to go to one yet, right?
No.
You only want one in the end. But at that point in time, what's the right number that you'd be like, hey, this is really a good process?
Yeah. And the answer is it varies from deal to deal, right? In some instances, it might be a more nuanced business where you're not going to get as many bids. I mean, we were fortunate with Exacto. We got a lot of good feedback from the market because there were a lot of really exciting things about the business. In some instances, you might say, look, 4 or 5 groups moving through to the next phase makes sense because we feel very confident in who they are and that they can get there and they can get done. Or not every process is incredibly robust. I mean, sometimes, again, businesses are very specialized and there's a smaller buyer universe that exists for them. On the other side, like you said, this is a grueling process. It takes management kind of out of their day jobs, or at least, a good portion of their time out of their day jobs for weeks at a time. And so you can't do this indefinitely. So probably on the high side, doing 12 to 15 of these meetings is the most I've seen. if you look on average, it's maybe 8 to 10. I think in the case of Exacto, we actually did double-digit meetings because we felt like we had a lot of parties who were all kind of in the same range, and it was hard to differentiate, and we wanted to keep as many around as long as possible.
So what is a management meeting then?
Yeah.
At this stage?
Yeah. So what we call the management presentation. This is the next chance to have another 50 or 60 page document. So these are half day sessions where the management team will basically present the business to the buyers. So, we like to have a well-represented management team. In most cases, it's the CEO, the CFO, probably the head of operations, a commercial lead, somebody from technical or research and development. Different businesses have different core people that need to be in the room to tell the story the best way and to communicate that to buyers. Buyers on the other side, they will bring probably just as many people. So you've got 6 to 10 people on the other side of the table that are taking in this information now from management. And like I said, it's a half-day session where we go through in great detail a lot of the information that was in the confidential memorandum, but also now kind of trying to peel it back a layer deeper, and being confident that you can share a little more information because the groups you're talking to are serious about the business.
Yeah.
Now, it's also important, we don't want those sessions to just be a presentation. We want it to be a conversation between the two sides. And so we encourage interaction between the management team, between the interested party from the buy side. And the more that becomes a dialogue, those are the best sessions because everybody kind of comes out of it needing what they need to get out of it.
You want, back to you. In the same way you want the chemistry and the learning and the alignment, for it to be a good transaction, it's got to be good on both sides, right? And you need to make the right fit, and it does strategically make sense for what that buyer's looking for.
And buyers know that they're in a competitive situation, right? I mean, they know that they're not the only group coming in, and so they want to make a good impression with the team. They want to sell why are we the right group to partner with, right? So it goes both ways. You're selling to them, and they're kind of selling back to you a little bit.
And some of the buyers were like, we want to get to the factory. And it's like, well, no, let's not do that, right? I mean, we hosted in our office. We were joking before we did this.
It was great. Yeah, it was fantastic.
One of the benefits of being in Chicago with O'Hare Airport here, everybody could fly in, meet in our boardroom, and then turn around and fly back out again.
We're not always fortunate to have hosts like you for these, so thank you. Yeah.
And so for us to be able to facilitate that, to have it offsite, neutral, because again, maintaining the confidentiality of all of this is hugely important.
Yeah.
And when people are talking about buying it, it's not yet the time to go to the factory for the management meeting. It's like, nope, let's keep it quiet for all the parties involved.
And it can vary. In some instances, some teams are, again, maybe if you're doing 12 meetings, you don't want to do it in a company facility. So having a neutral place to do it is critical. You want to do it in a place where buyers can get in and get out and not, come in a day. And so being able to host meetings 20 minutes from O'Hare is pretty fortunate because, you've got buyer groups coming in from all across the country.
Yeah.
And so we made the decision that we didn't want all these people kind of traipsing through the facility. It was important to Kenny and the management team to keep confidentiality around the process, so the organization wasn't trying to figure out what's going on. So one of the tools we often use in those situations and actually worked pretty well was we had a group come in and make a video of the facility, and so that was another thing that we did earlier on in the process, and then we were able to, during the right time in the management meeting, take a 20-minute break, let the team kind of, have some lunch or drink some water, and then play this video so that somebody could actually get a view of, okay, what's actually happening there, and get a chance to see it without having to have all these people walking through the facility. And not to mention, not every business is in the most conveniently located place, right? So it's hard to get groups there sometimes.
And so the management meetings are going on. All the discussions are happening. The list gets shorter because they're not a series of meetings, right? It's singular for each of the potential buyer groups for that 4 hours plus or minus that came in, at least for this particular transaction. What happens next?
Yeah. So coming out of the meetings, which by the way, the meetings are very taxing on management. I mean, they're kind of doing the same presentation multiple times, and they've done probably 15 dry runs with us before they've done it. So it's something they spend a lot of time on. Coming out of the management presentation, at that point we give buyers access to what we call the virtual data room. So this is there's third-party hosts that will basically take a repository of information from the business. We're building this in the background by the way this whole time. So we'll give buyers access to this. So this really now is starting to get them deeper and deeper into the weeds of understanding the business. So the detailed financial model, all the financial detail going back, getting access to audits, understanding who the customers are, being able to review customer contracts even, or supplier contracts, things like that. So this is really starting to get detailed.
In that amount of information, right? And as you go through, because how many files ended up in the data room? I don't know if you call it the top of your head.
I mean, probably thousands.
Right.
When you
and so when we talk about planning for an exit and being organized,
Yep.
do you have if you don't have your all of your supplier agreements in place and understood and documented, then work on that, right? Because if you get to a point and you're looking to sell, and we don't have that done.
Yeah, we can't find it.
We can't find it, or it's like, okay, then the discount continues to come off of the price tag.
Right.
So the more prepared you are, the more organized you are, the more you have everything from your various teams well captured. Again, do it for yourself, right? Do it for you already own the company. Make sure you get everybody organized in what they're doing. And if you do it in advance, it makes it way easier to populate the data room after at this point in time in the process versus trying to recreate everything at that point, because you're still running the operation and now you're running this process, and your key leadership is involved in both.
Yeah, and a side note to that, because that's exactly right, is being prepared. One pitfall that the groups can fall into is not having robust accounting systems or financial management systems. I mean, maybe it works for what you're doing day to day running the business, but you're going to get 500 questions that you need to answer, and you need to have kind of the data at your fingertips. And if your systems don't allow you to do that easily, it's a lot of extra time and effort.
Right.
So that's another thing to think about as you're going into this, is how do we quickly process information and give people a picture of our business. Being able to run reports and having a system that's set up and allows it to do that, and that's a lot of what gets put into this data room ultimately.
And so listeners to pause on that. I mean, you said it, but it's like you have the data room. There's accessing the data, but then there's an ongoing stream of Q&A that's taking place, saying, "Hey, we saw this. What's this about? We saw this. What's that about?" And that list of questions and answers is also hundreds long.
Yeah.
In terms of nuanced details that come into place that need to be addressed. This is just due diligence in the process.
Yeah.
So having the team ready for that, and again, prepared and organized, do it for yourself. But then if you're going to enter a process, it does behoove you to have that done way in advance.
And I will caution people that as prepared you are, as all the work you do, you're still going to get hundreds of questions.
Absolutely.
So it'll make it easier for you to answer them, perhaps.
Right.
But it becomes something that is often very frustrating for our clients. Is they get asked the same question 5 times, they feel like, and they're like, I told this to them a week ago, and now I'm getting somebody else is asking me, and so it's a difficult part of the process. It's something that as bankers we're trying to play traffic cop as much as we can, where we're saying, all right, we already know the answer to that because we've seen management answer it. We'll take it off their plate and handle it. Or we've got 3 different groups asking for the same thing. How do we just kind of consolidate those requests? So it's an important part to have your banker be able to kind of really help you navigate that process, but it's still going to fall on the team, and especially the finance function can really take it the most. They take the brunt of it.
Well, and that's so you said it again, right? But to repeat it, it's like you're not just dealing with one buyer in the data room. You're dealing with multiple
buyers
that are asking the hundreds of questions, right? That could be the same question across the board, but they have the right to ask, whatever they want to ask.
You're asking them to write a big check,
right? So they get to ask whatever they want to ask.
Yeah.
So as they go through all of that, that winds down. What's the next step as we continue to go down this path?
Yeah. So once they've been through the management presentation and they've had access to the data room for a period of time, we have the next check-in or the next bid, which is the LOI, the letter of intent, and this is a more fulsome, a much more kind of precise view of value of the business, a much a much more robust, offer, so to speak. And so, and say you do 10 management presentations, you may have 5 groups that's ultimately decide to submit an LOI, because others are going to learn things along the way that, they say, maybe it's not exactly what we thought it was, or we still like it, but we like it at a value that's probably not going to be interesting to the seller. So the groups that you can tell are still interested, you continue to encourage to do their work so that their LOI they submit is as fulsome and robust as possible. So there's hopefully less work to do on the other side of it. So we'll get those next bids. This is another point where we need to spend time with our client and the board and the advisors and make some decisions. The lawyers are going to get involved too at this point, because it's starting to become clearer and clearer who the right parties are going to be, and not only what do their proposals look like from an economic standpoint, but what does it look like from a potential legal exposure standpoint, or things like that. So it's very important at that point to make. You may make a decision that we're going to pick one and just run to try and get a deal done as quickly as possible. You may say, we've got 2 that still are really interesting and need to do more work, and so we'll try and run 2 as far as you can. It's hard to do too many more than that coming out of this stage, because the diligence is even going to become more intense, and they're going to be hiring third parties to help them do work, and the buyers at this point are spending money, maybe hundreds of thousands of dollars, to do all the work they need to do. So they're going to make sure they get everything they need, and that's gonna be difficult for most companies to support more than a couple of groups doing that at one time. So call it, you come out of the LOI process, you make a decision of, okay, maybe it's this one group, maybe it's these 2. You run them through diligence for, again, a couple more weeks, and then you push them to get to basically a signed purchase agreement.
And then the time. So let's kind of narrow it down even further. You select one for all the reasons, not just the highest price, right? But there's a lot of reasons that really should be thought through in terms of who you're partnering with, especially if you've got rolled equity into the new entity and carrying that on. Or you want your legacy carried on if it's a strategic and you're completely out of the subsequent entity.
Right.
So there's a lot to be taken into consideration. But when you get to that point, you're like, okay, here's the one I want to marry. There's still time that takes place before you actually have the closing.
Yeah.
What takes place during that time frame?
Yeah, so that's where a lot of times it's negotiate. I mean, hopefully by this point, usually coming out of the LOI, you've got the economics of the deal generally are in place, right? We understand what the purchase price is going to be. It's subject to them still finishing, these 10 things from a diligence standpoint they need to do. A lot of them are what I call kind of book report due diligence, where we need to make sure you have your benefits in place. We need to make sure all your insurance is up to date. Things that aren't necessarily going to scuttle a deal, but it's still work and things that need to get done. In the meantime, the lawyers are now probably madly negotiating the purchase agreement with the attorneys from the buyer's side of the table, right? So I kind of skipped this part, but typically when we open the data room, so all this information we're giving them, we're also giving them, the buyers at that point, a bid draft, the purchase agreement. So this is the point where they can start looking at, okay, what from a legal perspective is this seller looking for? What do they want to achieve? And how are we going to, kind of react to that? Okay. So part of that LOI process, oftentimes we may not get a fully marked up purchase agreement back, but we may get at least an issues list or an issues memo where we understand, all right, if the price is right from a legal perspective, are we going to be close, or is there going to be a lot of work to get done to get this thing over the line? Yeah. And so that's really where the lawyers now are burning the midnight oil and working hard to get something done that everybody can sign up to ultimately.
And that's still running another 30, 45, 60 days, right, to get to that point. Again, the entire process can take a long time. It can be fatiguing because of all these steps, but all the steps are still just prudent in the nature for both the seller and the buyer to make sure that everything is clean going through it. and then getting the wire instructions into all the different entities of where all the cash is flowing. So ultimately, the cash is in the bank the next morning, and everyone can get started with the next steps. Which were plentiful, but we're going to leave it there in terms of the conversation, right? That we're taking place.
Now the banker exit stage left, and
right?
You guys can
on to the next one. But when you sum up this in entirety, you have a listener out there that's thinking about this potential, right? They've gotten to the point, they've done their strategic plan, they've been running a tight ship in terms of the organization, and they're like, yep, I was going to go down this path. Two items. One is, what other advice would you have for them before they picked up the phone and gave you a call? And if they were going to pick up the phone and give you a call, how do they get in contact with you and Hennepin Partners?
Yeah, I think in terms of the first piece of that is, unless you've been through a sale process, you've sold a company before, I think you have to be prepared that you're just not going to be, you're not going to know everything that's going to happen. And so, being prepared to be flexible, we talked about it early on, but hiring an advisor that not only is going to give you advice on how to run the process, but help you kind of manage through the ups and downs of what's going to occur, because it's not all easy, and it's a lot of work. So it's not something that I would suggest you just dip your toe into and say, hey, well, maybe we'll try and sell the company and see what happens. I think getting to a point where this is what we think is the right thing to do, and assuming we get to a value that's acceptable to us, you're making a big investment to go that far.
Yeah, absolutely. So how do people get in contact with Chris Geyer?
Yeah, well, I'm sure we can give them our information. We're hennepinpartners.com. We're always looking for opportunities to talk to people about situations. Sometimes it makes sense. You don't need to wait till the last minute to contact a banker too. Start developing a relationship with a banker maybe a year or two before you think you're going to do it, and you can start doing some of that planning work early on, and have someone who'll be there to give you the advice. And we're happy to do that. I mean, we often are in kind of the quote unquote courting phase with a potential client for 6 or 12 months before we ultimately go to work, because it makes all our jobs easier if everybody's prepared.
Absolutely.
On both sides.
Chris, thank you again. This is where I go back to Kip. If people listen to Kip's episode, right, one of the things Kip highlighted is, you got to go get the right banking group to represent and run through the transaction, because of the complexity of this. If you think you can do it yourself, you just can't. From the network and the organization, the disciplines. And if somebody does this once in a lifetime, it's a huge event, right? Some people that might be lucky to do it a couple times. You're doing this all day for decades of your career, the team that you all have. And there's a reason we selected you, and there's a reason that we're having this conversation today. Nothing but the greatest respect and appreciation for what you've done. And as we left it with Kip, his 49th, looking for a 50th. We'll be.
I think I'm at 45, so I'm a few behind Kip, but I'm trying to get there. But
well, maybe we can all work on another one together here then too.
No, but thank you, John, so much for having me and allowing me to participate in this great conversation. And it was a pleasure working with you on the transaction, and the role you played with Kenny and the team cannot be understated as well. So it's a pleasure to keep the dialogue going.
Well, on behalf of all of us too, and both at Clearwater Capital, but also at Cox Fimi Holdings, appreciation to you, to Matthew, the entire team in Hennepin. Still feel great about what's there and what's yet to come. And I think Kip foreshadowed a little bit of that in the last one too. So Chris, thank you again. Listeners, if you do want to continue the conversation or get in contact with Chris, please reach out to us at clearconversations@ccpwealth.com. Have a blessed day.